Good morning, everybody, and welcome to this month's sustainability webinar. So today we are continuing our journey through AASB S2. Um, as always, I'm Aletta Boshoff and I'm presenting this sustainability webinar. Now, you will remember last month I've presented the webinar from Europe. I'm back. I've got a scarf on. It's a bit of a temperature shock to be back in Melbourne. Because in Europe they've experienced or currently experiencing a heat wave. So when we were in Paris, the Eiffel Tower was actually closed. You couldn't go and visit or go up the Eiffel Tower. Luckily, we had another opportunity later in the week. So very interesting. I'm back in Melbourne with my scarf and ready to present the next webinar. Now, BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, if we look at the monthly sustainability webinars, believe it or not, we're already in July, month 7. And therefore, we're looking at Pillar 3, Climate Risk Management Made Easy. You will remember that in June, we also looked at AASB S2 Pillar 3. Next month, in August, we move on to Pillar 4, Metrics and Targets. We'll look at that in August and September. And then we'll move on to carbon credits in October. And finally, in November, preparing that first mandatory sustainability report and making sure it's assurance ready in December. So please register for these webinars. If you've missed any of the webinars this year or last year or the previous year's sustainability webinars, you're welcome to go to our website. You can download the slides and you can watch the recording. We also have monthly IFRS and corporate reporting webinars. For those of you who have attended last week's IFRS and corporate reporting webinar, it was presented by Kevin Frobers and Dean Arden, and they looked at accounting for financial liabilities. And next month in August, we will look at accounting for technology and software costs. And then I want to call out October because in October we look at accounting for Australian carbon credit units, ACCUs, which is very important also from a sustainability perspective. Then the carbon accounting masterclasses, hugely popular carbon accounting masterclasses. We are doing our next quarterly virtual carbon accounting masterclass on Wednesday, the 3rd of September. It's an all-day event. I'll be presenting it, and you can use this link to register now. Please join us. I think it's really important that to join the masterclass because we don't only look at the greenhouse gas protocol, we take it a step further. We look at practical implications and, very important, how to be assurance ready. How for each and every category do you reconcile your data back to the general ledger for completeness purposes and also being audit ready. And so the next one is Wednesday, the 3rd of September. And if you can't make it then, the one after that will be Wednesday, the 3rd of December. The other thing that I would like to flag, and I know I flagged it last month, but to reiterate if you've missed it, excuse me, we have launched our AASB S2 climate-related disclosures checklist, and you can download the checklist at the bottom of the slide. To give you a bit of an extract from the checklist, we've looked at the 4 pillars: disclosures across governance, strategy, risk management, metrics, and targets. And we've actually counted them. You can see there are 9 disclosure requirements across governance, 56 across strategy, 9 across risk management, and 44 around metrics and targets, which we'll look at next month. And then the 5th column are the general requirements from AASB S1 that is mandatory to be disclosed together with AASB S2. It's embedded in the appendix to AASB S2, so it's a one-stop shop. If you look at AASB S2, there are 31 disclosure requirements that's carried forward, so we've included those as well. Thank you very much to all of those people who's already downloaded the checklist, and also those people who've provided feedback on the usefulness of the checklist, and we really appreciate your feedback. And if you've got suggestions, recommendations on how to improve it, please send that through as well. In the checklist, we've included a rating scale to help you make your own assessment. So you can have a look at whether a disclosure requirement you think you're compliant, maybe there's a partial gap, maybe there's a significant gap, maybe you've not rated it because it's not relevant in the current year, like scope 3, or maybe it's not applicable to your business. But you can go through the disclosures, you can rate it, you can do a self-assessment. And this is, an extract of what it looks like for each and every question or disclosure requirement. We've got the AASB S2 reference, and you can also put in your assessment compliant, partial gap, or not rated throughout 149 disclosures. And then there's also a summary tab on the last page where you can say for each and every pillar, to what extent am I compliant? To what extent is there a partial gap or a complete gap or not rated? And you can get a bit of a snapshot whether you are ready for AASB S2. So we hope you find that very useful. Please provide feedback to me. And obviously, if there's some criticism or constructive suggestions or constructive criticisms, ideas, I would love to hear that too. Going on to this month's webinar, in June, we looked at Pillar 3. So I thought I'll do a bit of a recap of Pillar 3, risk management. First of all, it's important to understand where risk management sits within broad requirements of AASB S2. And this figure from the TCFD recommendations, I think, still describes it the best, because it looks at all the potential climate-related risks, whether it's physical risks or whether it's transition risks. And on the other side, it looks at all possible opportunities. So resource efficiency, energy source, products, services, markets, resilience. And it brings all those risks and opportunities together and says, how do these risks and opportunities impact the business's strategic planning? How does it impact risk management? And ultimately, how does it flow through to the financial impact? And it's the financial impact on your income statement, your cash flow statement, your balance sheet. So the focus of Pillar 3 is that risk management pillar. That's where it fits. As I said in June, the TCFD have amazing guidance documents that has not necessarily yet been replicated in the ISSB Knowledge Hub. And therefore, when you look at risk management, this document, the guidance on risk management, integration and disclosure really is the best available document to assist you with this pillar. And we worked through this document extensively in last month's webinar. I wanted to call out one particular aspect, and that is from that guidance, there's a statement that incorporating climate change risks into existing risk management framework of the business is likely to be the best way to ensure that the impact of climate change is properly considered in decision making. And this is absolutely what we see in practice. Those clients that embed their climate risk register into their enterprise risk register, those entities that consider identification, monitoring, management of climate risk as part of their normal risk management framework, definitely are most efficient and effective from a risk management perspective. So I just wanted to reiterate that point from last month's webinar. If you look at the AASB disclosures around risk management, these are the 9 disclosures that's in our checklist. They all come from paragraph 25. Only 9 disclosures, but it talks in disclosure 1, has the entity disclosed information about the processes, the related policies that they use to identify, to assess, to prioritize, and monitor climate-related risks? Has the entity disclosed information about the inputs and the parameters that they use? Has the entity disclosed information about whether and how it uses scenario analysis, climate-related scenario analysis, to inform the identification of climate-related risks? In number 4, has the entity disclosed information about how it assesses the nature, the likelihood, the magnitude of the effects of these risks? So we look at inherent risks, and inherent risks has 2 aspects, likelihood and magnitude. Then we consider potential controls, and we end up with our residual risk. In number 5, has the entity disclosed whether and how it prioritizes climate-related risks relative to other types of risks? So we wouldn't expect climate-related risk to dominate the risk register necessarily. We have to find a balance between all business risks, including climate-related risks. Has the entity disclosed how it monitors these risks? So it's not a set and forget. We identify, we assess, but then we have to monitor on an ongoing basis, not just the risks, but also the controls. Has the entity disclosed whether and how it has changed its processes compared to previous years? Now, that disclosure number 7 is not that relevant in the very first year of disclosure under AASB S2, because it will be the first year we disclose our processes. But in future years, if we've changed anything, we'll have to disclose how we've done that. Also in number 8, has the entity disclosed information about the processes it uses to identify, assess, prioritize, and monitor opportunities? So it's not just about risk, it's also about opportunities, and we need disclosures around those. And also, has the entity disclosed information about the extent to which and how the processes for identifying, assessing, prioritizing, monitoring risks and opportunities are integrated? So there's an actual disclosure where you have to say, yes, we've integrated it into our overall risk management process, yes or no, and this is how we've integrated it. So these are the 9 disclosures across risk management, and you will remember that we've stepped through this last month. Now, in these webinars, we also try and be relevant, and we try and address the questions that you, our attendees, ask. Now, the one question that we are asked, I would say daily at the moment, is what about materiality? How would materiality impact our disclosures required by AASB S2? I would say it's the question of the day or the month. And I suspect it is a showcase of how people have progressed. People have done measurement of carbon footprint. Businesses have done climate risk and opportunity assessments. Businesses have done scenario analysis. Now businesses have moved to the preparation of draft sustainability reports. And now the materiality question is very relevant. Because we've extensively discussed the risk management pillar in the month of June, I thought it would be best to focus on this question, which is a very relevant question and a topical question, and spend this webinar looking at materiality. Now, first of all, whenever we get questions, when people ask me questions and I go and do my research, and I'm trying to provide that research or reference materials to you, because in the webinar, I can touch on some of the research and reference materials, but don't always have the time to look at everything. Now, there's 2 documents that I would like to recommend if you look at materiality. On the left-hand side, the International Sustainability Standards Board that has issued the original IFRS S2, which we've slightly amended to get to AASB S2. They've issued educational material, and the document is entitled Sustainability Related Risks and Opportunities and the Disclosure of Material Information. So it's particularly looking at the materiality around risks and opportunities, climate-related or sustainability-related risks and opportunities. So absolutely the best reference document around materiality. Then on the right-hand side, I've also included a link to a practice statement that was published by the Australian Accounting Standards Board. Now, this practice statement is based on the International Accounting Standards Board's practice statement. And the title is Making Materiality Judgements. When this practice statement was originally published, it only applied to IFRS accounting standards. However, when you look at the document on the left-hand side, published by the ISSB, they specifically reference this practice statement. They specifically indicate that because accounting standards and sustainability disclosure standards have the same concept of materiality, it is good to go and look at this practice statement, and they have tried to reference this practice statement in their educational material, and they refer to it throughout the educational material. Now, I thought, I want to go back to the original document, Making Materiality Judgements, and therefore I've included both documents for you here as reference, and I'll look at both of them in this webinar because I want to show to you the similarities and how the ISSB is trying to connect, reference, refer to this practice statement. So that's two documents that you could look at. So I thought maybe it's best to go to the original literature and go to that IFRS practice statement too, Making Materiality Judgements. And I know it was originally developed for financial statements, but we now also apply it for sustainability related risks and opportunities. So let's go to that first. Now, in this practice statement, they start with a definition of materiality. And they say information is material if omitting the information, misstating the information, or obscuring the information could reasonably be expected to influence decisions that the primary users of these general purpose financial reports make on the basis of these reports, which provide financial information for specific reporting entities. So you can see here the focus on this practice statements is the primary users of general purpose financial reports. And remember, going forward, general purpose financial reports will not just be financial statements, it will also include sustainability reports. And that is why in the very first sentence you can already see why the concepts of materiality applies to financial statements and sustainability reports. Critically here, it is if we omit information, we misstate information, we obscure it, we hide it within a lot of other irrelevant information, if that could reasonably be expected to influence decisions of those primary users, it's not a good thing, and it's a problem. In other words, in the second bullet point, materiality is an entity-specific aspects of relevance. So to what extent is this information relevant to this entity and to the primary users of this entity? And we look at the nature of the information or the magnitude or the size of the information or both. So it's not just quantitative aspects or just qualitative aspects. It could be both of the items to which the information relate, and in the context of the entity's financial report. In the third bullet point, when you make these materiality judgments, and I want to focus on the word judgments, there's not a clear set of rules, requirements on how you do materiality. Materiality is entity by entity, and it's judgment. You look at quantitative and qualitative things, and you make a judgment call. When you make this judgment, an entity needs to take into account how information could reasonably be expected to influence the primary users of the financial statements or the sustainability report when they make decisions. So the objective of financial statement is to provide financial information about an entity. It has to be useful to existing and potential investors, lenders, and other creditors when they make decisions whether they want to continue to invest in the business, or whether they want to, sell the investment, or a lender, a provider of financing, whether they want to continue to provide the financing, provide more financing, etc. And an entity identifies the information that's necessary to meet that objective by making appropriate materiality judgments. So the whole time when we think about materiality, we think about our entity, we think about who are our primary users, so current and future investors, current and future financiers. That's the groups that we think about. And we think, would this be material to them? Would this influence their decisions? Now, coming back to judgment, when we assess whether information is material to financial statements and also sustainability reports, an entity applies judgment. So this is judgment applied by the entity and by management of the entity to decide whether information could reasonably expected to influence the decisions of those primary users. And when we apply that judgment, the entity or management considers specific circumstances, and how information provided in the statements respond to information needs of primary users. So it's important that an organization consider who are my primary users, what are their needs, and address those. The entity's circumstances can change over time, and therefore materiality assessments in the financial statements and sustainability reports should be reassessed at each reporting date, so the end of each reporting period. You cannot say it's not material in 2025 and therefore just assume it's not material in 2026. So it's all about judgment. Now, you would have seen in this discussion about materiality, it's all about primary users, investors, lenders, and their information needs. So an entity needs to consider the impact the information could reasonably be expected to have on the users. Now, these words are important. Could reasonably be expected, right? And you'll see that phrase throughout today's presentation around financial statements and sustainability reports. Could reasonably be expected to have an impact. Now, those users are existing potential investors, lenders, creditors. These investors, lenders, and creditors cannot demand information from the company. They have to rely on these general purpose financial statements, or these sustainability reports as part of the annual report. That's only information they receive, and based on that information, they decide to invest or to provide financing. Therefore, we have to really be aware of their needs and to enable them to make appropriate decisions. They also acknowledge in this practice statements that in addition to primary users, there could be other parties. For example, the entity's management or regulators or members of the public that could be interested in your financial information or your sustainability information. However, we have to remember that financial statements and mandatory sustainability reports in compliance with AASB S2 are only focused on the needs of the primary users. It's not directed at those other parties. It's fantastic if they find the information useful, but the idea is not to address all their needs. Absolutely investors, financiers. And also, it's not just current investors, it's potential investors, potential lenders, potential creditors. And so we should consider their interests as well. Um, in this practice statement, they go a bit further and they want to give us some guidance on what they believe primary investors use and need. What information do they need? And they say, in general, an entity's primary users need information about the resources of the entity, so the entity's assets. They need information about claims against the entity, whether it's liabilities or its equity claims. They need information about changes in those resources and claims, changes in the assets, changes in the liabilities or equity. So that would normally be your income and expenses. And they need information on how efficiently and effectively the entity's management and the governing board have discharged their responsibilities to use the entity's resources. So that's why, if you look at this, they need information about assets, but also the impact that climate change would have on the value of these assets. They need information about liabilities, and then from a sustainability perspective, how climate change and climate-related risks and opportunities would impact these liabilities, would impact income and expenses. And very importantly, whether management and the board are efficiently and effectively addressing, managing those climate-related risks and opportunities. So you can see how this practice statement not only apply to financial statements, but also sustainability reports. Now, in this practice statement, they've included a 4-step materiality process. And they said these are the steps that could be used, so it's not mandated. They've identified these steps that could be used as a possible approach to the assessment of materiality in the preparation of financial statements. And they said, step 1, you identify information that has the potential to be material to these primary users. So let's look at all the information that we think potentially they would be interested in. That's step 1. Then in step 2, assess whether that information that you've identified in step is in fact material. So not all the things that you identify would end up being material. You've got a big list of potential material items, and then you assess it. In step 3, you organize the information in your draft financial statements, and you organize it in a way that you believe communicates the information clearly, concisely, to primary users. And then in step 4, once you've drafted it, you review the financials. And when you review the financials, you have to consider whether all material information has identified and has been included, and that it, whether it is clear, concise, it's not obscured, it's not incorrect. Should it be aggregated further? Should it be broken down further? But you review it, and that's how you go through your materiality assessment. So you can see very clearly, even for financial statements, there's not a hard and fast line on this is material and this is not material. You have to identify information that's potentially material. You have to assess whether it's in fact material or not. You have to draft it in the financial statements and then review it. So it's a process. Now, this is a diagram from that practice statement where they said if you look at identifying, you consider the requirements of the standards. You consider also in step 1, not just the requirements of the standard, whether it is the accounting standards or AASB S2, you also consider your knowledge about your primary users and their information needs. Then in step 2, when you assess all of that potential information, you consider quantitative factors and you consider qualitative factors that could be entity specific but also external. So it's not just entity specific, also external information. Then in step 3, you organize it in your draft financials or draft sustainability report, and step 4, you review it. So it's just a visual of how we work through the sustainability process. Now, this guidance statement was already issued, I think, in 2020 around accounting standards, and BDO have written 2 articles around it. And I've provided links to the 2 articles. Initially, when we wrote these articles and when this document was published by the International Accounting Standards Board, AASB, it was purely focused on financial statements, but since then, also extending it to AASB S2. Now, if you look at this particular, I now want to move on to the sustainability AASB S2 perspective and look at that guidance issued by the International Sustainability Standards Board. So if you look at the objective and the scope of AASB S2, let's take a step back. AASB S2, the objective of AASB S2 is to require an entity to disclose information about climate-related risks and opportunities that is useful to primary users. So it's the same primary users of the financial statements: investors, financiers, current investors, financiers, potential future investors and financiers. So it's the primary users of the reports, again linking it to making decisions relating to providing resources to the entity. So that's why we've got AASB S2. Primary users don't only want financial information, they insist on also having information about climate-related risks and opportunities, because that could potentially impact the decisions they make to invest in a business or to finance a business. So that's the objective of AASB S2. Now, if you look at the objective paragraphs, there's an interesting bit, and I'll explain the colors that I've used shortly. AASB S2 requires an entity to disclose information about climate-related risks and opportunities. And here you can see the phrase that I've mentioned earlier when we looked at the definition of materiality. It's the risks and opportunities that could reasonably be expected to affect the entities, and now they list 3 things. It could affect the entity's cash flows, its access to finance, its cost of capital. So the cost to raise debt capital or equity capital. So if it's reasonably expected to impact their cash flows, so inflow of cash, outflow of cash, so that is revenue, expenses, its access to financing, its ability to get financing, and the cost of that financing, whether it's debt or equity, over the short, medium, or long term, then it has to be disclosed. Now, what they've said in AASB S2, and it's often overlooked, you would often see in AASB S2 that they talk about climate-related risks and opportunities that could reasonably be expected to affect the entity's prospects. So I've put prospects in red and in bold. Whenever you see the entity's prospects throughout AASB S2, you should think about what I've got in red in bullet point number 1. Prospects means cash flows, access to finance, cost of capital over short, medium, or long term. Now, they didn't want to use that long phrase in bullet point 1 the whole time, and therefore they said, we're going to use this shortened phrase, and prospects means cash flows, access to finance, cost of capital, short, medium, long term. So I just want to make that very clear, because this has an impact on assessing what risks and opportunities would be disclosed. Then when you look at the scope of AASB S2, it says AASB S2 applies to climate-related risks and climate-related opportunities. And climate-related risk and opportunities that could not reasonably be expected to affect the entity's prospects. And remember, prospects has a bigger meaning: cash flows, cost of capital, access to financing, short-term, long-term, medium-term. If these risk and opportunity could not reasonably expected to affect the prospects over the short, medium, long term, then they are outside the scope of AASB S2. A lot of people look at this second bullet point and they say, listen, it's not reasonably expected to affect our prospects, and therefore they want to exclude it. Remember, prospects are defined as cash flows, access to finance, cost of capital over short, medium, or long term. Forever and ever. It's not going to impact you. It's a big call to make. So prospects, please be careful. When you see prospects, it's got a bigger meaning. If we go on, so that's just the objective and the scope, and I wanted to articulate that prospects aspect. If you look at the definition of material information and how that is applied in AASB S2, let's go back to the use of materiality in AASB S2. The definition of material information in AASB S2 focuses on whether information could reasonably be expected to. Can you see that phrase again? Could reasonably be expected to influence the decisions that primary users make on the basis of these reports. And these general purpose reports includes financial statements and sustainability related financial disclosures, in our case, climate related financial disclosures. So similar terminology to the definition of materiality in financial statements. And then again, they articulate, remember, primary users are existing and potential investors, lenders, and other creditors. So when we say materiality in accounting standards and materiality in AASB S2 is the same, you can see the words exactly the same. We're looking at could reasonably be expected to impact decisions. It's about primary users. It's all about judgment. So very similar process. Then the other thing is when you look at AASB S2, and do yourself a favor, go and search for the word materiality in AASB S2. It's not in there at all. So materiality doesn't appear in AASB S2. How it is factored into AASB S2 is it talks about information that have to be disclosed, and that material information has to be disclosed. Right? So you can't find the word materiality or a definition of materiality in AASB S2, but you have to look at information. Information will only be disclosed if it's material. So materiality is really used to assess whether information that's required by AASB S2 would need to be disclosed by an entity, because it will only be disclosed if it's material. In other words, that definition of material information is used as a filter. And I love the way this is described in the guidance document. Information will be included in your sustainability report if that information is material information. So it's a filter that you look at. You have to assess whether information about a sustainability related risk and opportunity would need to be provided in the standard. And you'll only disclose information about sustainability related risks and opportunity if it's material information. And again, we'll apply our judgment. So it's a bit of a filter. Now, very interesting, and I want to call out the first bullet point here. The term materiality is not used in AASB S2 in relation to the significance or the importance of a climate-related risk or opportunity. So we're not looking at our risks and opportunities and saying, let's see whether it's a material risk or material opportunity. Let's see if it's a significant risk or an important risk and opportunity. That's not how you use materiality at all. Materiality is about material information, not about material risks or opportunities. That's a different assessment, and I'll show you that shortly. So AASB S2 requires disclosure of information, and I've put in brackets, it requires disclosure of material information, and that's where we use materiality, material information about sustainability related risks and opportunities that could reasonably be expected to affect the entity's prospects. So there's a two-phase going on here. There's a part A where you look at risks and opportunities and you consider all of these risks and opportunities. Could they reasonably be expected to affect the entity's prospects? So cash flows, access to financing, cost of capital, short-term, medium-term, long-term. If they could reasonably be expected to affect the entity's prospects, it's a relevant climate-related risk and opportunity that should be disclosed. Then, if you want to decide how much information to disclose about those risks and opportunities, you consider whether all that information that you've got available on those risks and opportunities are indeed material. So in considering what could reasonably be expected to affect an entity's prospects, an entity should consider an external perspective. So if you look at risk and opportunities, and that first part is to assess whether these risks and opportunities could reasonably be expected to affect the prospects, you think external. So would an external party, in particular, external primary users, expect this risk and opportunity to be assessed and be relevant for your business? Right, so that's a really important thing. External party, external primary users for your industry, for your type of business, would they reasonably expect you to consider, identify, assess, manage certain risks and opportunities? So it's an external perspective. When we then move on and we look at the information aspect, when we look at materiality judgments around the information, we assess whether omitting or misstating or obscuring information could reasonably be expected to influence their decision. When making those judgments, an entity considers whether if the information is omitted, misstated, obscure, would it change their decisions? And remember, they make decisions around returns, around dividends, principal and interest payments, market prices. So if any of this information could impact their dividends, could impact their interest payments, could impact the market prices of their shares, it would be material. And those expectations depend on the user's assessment of the amount, the timing, uncertainty of future cash flows, and whether the entity is appropriately managing efficiently, effectively the economic resources of the business. So this is a bit of a, I like color and I like pictures. Taking all of that, I thought if you look at materiality in AASB S2, I think there's two parts to it, which is easily confused. There's a part A around a climate risk and opportunity assessment. So you assess whether a climate-related risk or opportunity could reasonably be expected to affect the entity's prospects. And remember, we mean cash flows, access to finance, cost of capital, short, medium, or long term. So if you look at risk and opportunities, if it could reasonably be expected to affect the business's prospects, we have to consider it. We have to include it in AASB S2 disclosures. And remember, it's an external perspective of primary users. If we say yes, these risks and opportunities could reasonably be expected to impact our prospect, then we go on to part B and we look at all the information, and we have to identify and disclose material information, because as a business, we will have a lot of information about these risks and opportunities. So which of those information that we have is material and should be disclosed? So can you see there's a first step on what are the risks and opportunities, and then all the information we have about those risk opportunities, which of it should be disclosed, and it's material and should be disclosed. I've got two suggestions here on a way to think about the material information. Could the information reasonably be expected to influence decisions that primary users make based on these reports? And the second way, slightly different, assess whether omitting the information or misstating the information or obscuring the information, hiding it within other information, could reasonably be expected to influence the decisions of users. So I hope this diagram provides some guidance on how to think about materiality. So materiality comes into the second block, and it's about material information. The first one is around what are the risks and opportunities, could it reasonably be expected to impact our business? It's a different assessment. So if we look at that second part, identifying and disclosing material information, not all information, only material information, the guidance document or the educational material talks about once you've identified your risks and opportunities, sustainability related risks and opportunities, you need to identify and disclose only material information about those risks and information. You don't have to disclose all information about the risk and opportunities. And it's all, AASB has been designed to result in an entity providing information that is useful for decision makers, for the primary users of these reports. And therefore, you don't disclose everything. That will confuse them. It's too much information overload. It will obscure important information. You'll only disclose material information. Now, interestingly, in this educational guidance, they also include a four-step approach. Now, this four-step approach is exactly the four-step approach that I've previously shown you from the guidance document for accounting standards. And remember, they said we apply the same approach, and that's why the four steps are the same. And they say this is an example process. It's similar to what you use for your financial statements. So step one, you identify information about your risk and opportunity that has the potential to be material. So you know what your risks and opportunities are. Now you identify what of the related information do you think would be material. You then assess whether that information is in fact material. Once you've got it all out, you think, wow, this is just too much. It's not all material. How do we group it? How do we aggregate it? To get to good communication. Step three, you organize it in a draft report. And then step four, now that you've got it in the draft report, you look at it holistically, you review that report to make sure that you've got all the material information. So there's another discussion. Sorry, I've clicked too fast. In the educational guidance, they also talk about primary users and their information needs. So very similar to what we have for accounting standards, they try to make it more relevant to sustainability information. And they say an entity assess whether information is material based on whether that information could reasonably be expected to influence decisions of primary users. And although the entity makes this assessment, it should be based on the perspective of primary users and their information. So examples, information about sustainability related risk and opportunities that management maybe determines could not reasonably be expected to influence their decisions would not be to be considered to be material. But you have to say, not it's not relevant for management, it's not relevant for the decisions of our primary users. Important information cannot be assumed to be immaterial because your users have not yet asked for it. Right? So we should anticipate what users could expect in future, could ask about in future. And that information about your risk and opportunities considers to have a low likelihood of occurring and a low impact could still be material. So although there's a low likelihood, a low impact, so it's a low inherent risk, it could still be material if an entity considers that your primary users might expect to have a different view. So you've looked at it and you think it's low likelihood, low magnitude, and you've got a low inherent risk. However, you think the users, based on what they see in the industry, might expect a different approach, then you still have to disclose it. And you might have to explain that you think it's got a low inherent risk, or you think it's got a low residual risk because you've got controls in place, but because users expect it, you have to explain to them why it's not relevant for your particular business. All right, so it's very important to look at that, to the expectations of primary users. And then also they make the statement again, we know a lot of people, regulators, members of the public are interested in your climate related disclosures, but that's not the purpose of this sustainability report. We focus on primary users only. They also give us some explanation on what are the information that your primary users would like to see from sustainability information. So they would say the following things would impact their decisions. So they would be interested in information that could impact them buying, selling, or keeping their shares, or continuing to provide loans to your business. They would like to see information that could impact, whether they continue to provide these loans or any other forms of credit. That might impact their exercising their rights to vote or influence management's actions that affect maybe economic resources. So, for example, if you've got shares in a business and you are seeing that they're not addressing climate risk or climate change, and the users think climate change is a risk for the business, they could sell their shares because they cannot see how the business is addressing a very real risk for the value of their shares. So if users would expect to see this information, you have to provide the information and explain how you're managing it. So you give them confidence that they continue to keep the shares and they continue to provide financing to you. They also expect to see information that will impact their dividends in future. So if climate change will have an impact on your revenue or your cost, and therefore they get less dividends, they want to know that. If there would be an impact on your ability to repay your loans or interest payments, or an impact on the market prices of the shares in your business, they want to know that. So also these expectations will depend on the amount, the timing, uncertainty of cash inflows and outflows. And very importantly, it's not the cash inflows and outflows, but they want to see the stewardship of the entity's resources. To what extent do management and the board, to what extent are they good stewards of the money that they've invested in this business or the financing they've provided to this business? If you look at the sustainability related financial disclosures, although that definition of material information in AASB S2 is aligned with the definition of the same term in our IFRS accounting standards, the information required to meet the objective is quite different. Financial statements have a historical perspective, where sustainability information is often forward-looking. So your application of materiality although it's based on the same core principle, could be somewhat different. When they look at sustainability-related disclosures, a few key principles. Sustainability-related disclosures will complement information in the financial statements, and that's why it's sitting side by side, and it shouldn't contradict information in the financial statements. There's a linkage and an integration. Sustainability disclosures are likely to include more qualitative information, descriptive information, and include more forward-looking information than financial statements. Financial statements have a historical view often. It will also provide information that could reasonably be expected to affect the prospects, whereas financial statements provide information about the entity's assets, liabilities, equity, income, expenses at a point in time with a historical view, where sustainability information is future looking and it's looking at future prospects over the short, medium, and long term. So very important, valuable information. So if you look at sustainability disclosures, it's not limited to information about whether those risks and opportunities have affected the assets, liabilities, equity. That's part of it, but it also looks at the anticipated effects in the next financial year, in future years, under different scenarios, right? So it's real valuable information. Very important, when you prepare this information, you have to consider implications over longer time periods and consider implications and interactions with your value chain too. Now, in this educational material, there's a number of interesting diagrams or figures or tables that I wanted to flag that I think will be handy. In this table, they look at the 4 steps. You identify information around sustainability-related risks and opportunities that's potentially material. That's the step. The output could be a list of potentially material information. Then in step 2, you assess that list. And what's the outcome? A preliminary set of material information. Then you organize it, you draft it in your sustainability report. So you have preliminary material information, you draft it in step 3, and then in step 4, you look at it holistically and you review it. So it's a process to go through. It's not bang, this is material, this is not material. It's not a quick decision. It's a process. When you look at quantitative and qualitative factors, people often ask me about this. It's important that you could identify information as material looking at quantitative factors or qualitative factors or both. In general, the more factors that apply to a particular risk or opportunity, the more significant the possible effect of those factors, and the more likely that the risk or opportunity is material. So if we think it could be quantitative material, it could be qualitative material, it's definitely one of the things to think about. There's no hierarchy. So it's not as if quantitative factors are more important than qualitative factors. And there's no hierarchy. And an entity assesses materiality considering quantitative and qualitative factors, and it would be inappropriate, they clearly say inappropriate, to only rely on numerical guidelines or to apply a uniform quantitative threshold for all materiality judgments. For each sustainability-related risk and opportunity, you should consider numerical guidelines and or qualitative guidelines unique to that risk and opportunity. So you can see a lot of judgment. These are some additional examples. I can see I'm running out of time that you could look at. I've expanded a bit on quantitative and qualitative factors because that's often a question. I've also included an extract in table 3.1 on examples of entity-specific qualitative factors and external qualitative factors. So external qualitative factors could be your geographical location, your industry, your sector, the state of the economy. All of those things could have an impact whether primary users care about certain information. So important to have a look at that. So I think that's a good example. Um, there's also a discussion that you have to consider possible future events with uncertain outcomes. And I think the diagram is the best way to look at it. They say here, if we have uh, future risks and opportunities that have a high impact and a high probability, they would be more likely to be judged as material and material information to disclose. However, if you have a low probability but a high impact risk, that could also um, reach the materiality threshold, especially if there's an expectation of your users, your primary users, to see that disclosure. And it could individually reach the materiality threshold, or maybe in combination with other low probability risks and opportunities. So important to consider all of that. Important that you look at future effects and uncertain income outcomes. I've included an example. Again, this is another extract from the publication, what gives you a number of examples of materiality judgments that could change over time. And I think even looking at this in the very first year is interesting. Maybe in the second bullet point, maybe it is that an entity says information about a sustainability related risk has been assessed and management concluded it's effectively managed. So we have an inherent risk, we have a control, it's effectively managed. But management concludes that the primary users might take a different view, and then that information is still material and it have to be disclosed. So although you that are internal in the business think it's a low risk and you think and you know you've got controls to manage it, if you think primary users, based on their expectations and the state of the economy and the industry that you operate in, would expect a different outcome, you have to disclose it. Also, the third bullet point, maybe you've assessed and concluded that a risk is effectively managed, but it is reasonably concluded that the primary users might not be aware of the entity's mitigation activities. Then information about that risk and how it's managed is material. So you can see these are really good examples to challenge maybe the thinking you have around materiality. Maybe the last bullet point, maybe the entity has announced an intention to meet a sustainability related target that's related to a sustainability related risk or opportunity, but you've not yet developed a plan to achieve this target. Then the fact that you've got that intention and that target, and the fact that you don't have a plan, that is material information and should be disclosed. So you can see it's not an easy decision. When you review your disclosures in step 4, they give some guidance on some of the things to think about. All relevant relationships between different items of information have to be identified. If there are new relationships between information, then it has to be disclosed. Items of information that are individually immaterial, when considered together, could nevertheless reasonably be expected to influence decisions. So if you've got a lot of pieces of information that individually you don't think is material, if you group them together, they could influence decisions of users, then you have to disclose it. The information is communicated in an effective and understandable way, and it has to be organized to avoid obscuring material information. And also the disclosures provide a fair presentation of the entity's risks and opportunity. So those are just some of the things to think about. Now I'll conclude with this. There's two reference documents. There's the guidance document that apply to accounting standards and sustainability disclosure standards. Then there's also that specific educational material around sustainability disclosure standards. When you look at materiality, the most important thing is to apply judgment and to document your judgment before the auditors arrive. Why do you think certain pieces of information is material and other information is not material? Why do you think primary users wouldn't think this information would change their decisions? The other thing that I think is a big takeaway here is that material information is not the starting point. You start with identifying climate-related risks and opportunities that could reasonably be expected to impact decisions of primary users and the prospects of the business. And that's not materiality. That is identifying risk and opportunities. And then when you look at all the related information around those risk and opportunities, then you have a materiality overlay. So I think there's been a bit of a confusion around this. If you've got further questions, please email me. I would like to know about those questions and we'll try and address it in future webinars. How we can help, we do accounting, reporting, we do assurance. There's a bit of a description of all our services and all the people you could contact to assist you. You can also register for our newsletter. The July newsletter will be distributed tomorrow. And finally, I would like to thank you for joining me for this month's sustainability webinar. Apologies for running over time, but I think materiality is a really important topic to address as soon as possible. I hope you are well. I hope you are well advanced in preparing your 30 June financial statements if you've got a 30 June year end. And please remember to include some disclosures in compliance with the TCFD recommendations in your financial statements whilst we are getting ready for mandatory sustainability reporting next year. Thank you very much and good day.